The U.S. economy has contracted for the first time in years, and in a striking parallel, China has surged ahead, using its currency for a record $725 billion in global trade. The dollar hasn't been dethroned by war. It's being methodically replaced. And while Washington brushes it off as mere noise, the real question is, what happens when the rest of the world stops paying attention? In the wake of President Trump's Liberation Day tariffs, China's yuan has made a major leap, now accounting for more than 54% of all cross-border trade settlements in March, a total of $725 billion. This represents a historic high in non-dollar trade by China, a 12% rise from just 3 months earlier. Meanwhile, the U.S. economy shrank by 0.3% in the first quarter of 2025, marking its first contraction since 2022, primarily driven by a flood of imports ahead of the new tariffs. Bloomberg analysts note that the flood of pre-tariff imports distorted the real GDP numbers, while inflation remained steady and consumer spending slowed to just 1.8%, the lowest growth since mid-2023. Instead of pressuring China, the tariffs seem to have triggered a broader global shift, with countries moving away from the US dollar. What China does next with its yuan-based settlements is now a key concern for economists. On April 9th, Reuters reported that 3 independent sources confirmed the People's Bank of China ordered major state-owned banks to stop purchasing US dollars. This move, following a sharp drop in the yuan's value, is being seen as a tactic to stabilize the currency without depleting foreign reserves. The timing of this directive, coming right after a massive increase in tariffs, has raised eyebrows. Goldman Sachs analysts suggest it signals a deliberate decoupling from the U.S. financial system. Meanwhile, China's Ministry of Commerce has denied any active negotiations with Washington, directly contradicting Trump's claims of a major trade deal. China's reliance on the U.S. dollar for trade has fallen sharply, from 70% during Trump's first term to just 41.4% by March 2025, according to data from the People's Bank of China and SWIFT transactions. This shift isn't merely a statistical blip, it's a sign of a changing global order. Chinese exporters are increasingly favoring yuan-based invoices, especially when dealing with countries like Brazil, Russia, and Pakistan. In fact, Chinese energy companies have started settling oil trades with Gulf producers in yuan, bypassing the SWIFT system in favor of Beijing's own cross-border interbank payment (CIP) system. This marks a major change in global trade dynamics, signaling the yuan's growing influence. The implications are clear. The United States is, in effect, sanctioning itself out of key global trade channels. Analysts at Pantheon Macroeconomics point out that these tariffs are acting like a forced decoupling mechanism, pushing more countries to move away from the dollar. If these reciprocal tariffs persist into the second quarter of 2025, the displacement of the dollar could become permanent. The question is no longer if the dollar's role in global trade will shrink, but how rapidly the trend will accelerate as more nations follow China's lead. At the same time, foreign investors have been pulling money out of U.S. equities. Between March and April 2025, $63 billion worth of U.S. stocks were sold off, with 72% of that coming from European investors, according to data from the Securities Industry and Financial Markets Association, SFMA. Despite this, the S&P 500 managed to recover some of its losses by the end of April. But beneath the surface, this capital flight signals a deeper concern about U.S. market stability. J.P. Morgan strategist Marko Kanovich explained that this isn't just a short-term tactical move, it's a longer-term hedge against dollar volatility and the unpredictable nature of U.S. policy. With 18% of U.S. equity ownership held by foreign investors, continued outflows could significantly reduce market liquidity, especially if inflation continues to erode corporate margins. As China accelerates its shift away from the U.S. dollar, the implications are far-reaching. The U.S. economy was projected to grow by 0.4% in Q1 2025, but instead, it shrank by 0.3%. This contraction was largely due to a $49 billion surge in pre-tariff imports, which helped push the trade deficit to a record $117.8 billion in March. While some analysts argue this is a temporary effect of front-running, the underlying numbers are troubling. Consumer spending growth is at its lowest point in 3 quarters, pointing to a potential slowdown in the broader economy. China's strategic pivot away from the US dollar is unfolding in real time, and the global financial landscape is shifting. The question now is whether this is the beginning of the end for the dollar's dominance in global trade, or just the start of a long process. Only time will tell. Stay tuned as we continue to monitor this developing situation. The economic landscape continues to reveal mixed signals. But one thing is clear. Trade tensions and tariff policies are leaving their mark. President Trump has repeatedly claimed that companies are flocking to the U.S. in record numbers, but recent reports suggest otherwise. According to the Wall Street Journal, many multinational corporations are holding off on expansion plans, waiting for clarity on tariffs before making any significant moves. Meanwhile, Goldman Sachs warns that China's retaliatory tariffs could cost U.S. exports as much as $28 billion annually. If this is part of the administration's strategy, it seems to be pushing American companies out while creating openings for foreign competitors. But are we really witnessing economic strength, or are we just limping through tough times? Trump defended the Q1 GDP numbers, arguing that a 3% core GDP growth, after removing inventory and import distortions, was a sign of underlying strength. He also touted a 22% surge in domestic investment. But here's the catch. Neither the Commerce Department nor the Federal Reserve officially recognizes core GDP as a legitimate metric. Even more troubling, Bloomberg Intelligence points out that much of that investment came from inventory stockpiling, not new production. And while the economy wasn't in freefall, the job market certainly showed signs of weakness. ADP reported only 62,000 jobs added in April, far below the anticipated 200,000, raising concerns that the labor market may be stalling. Trump's rhetoric hinges on the promise of a manufacturing boom, but analysts at Fitch Ratings issued a stark warning on May 2nd, saying that tariff-induced cost pressures will continue to weigh on U.S. manufacturers. Plus, they believe the optimism around reshoring is overblown. As long as import prices stay elevated, inflation could surpass the Fed's 2% target, squeezing both consumers and the economy. The real question isn't whether Trump made his case, it's whether it's worth the economic price. Despite signs of slowing growth, Treasury Secretary Scott Bessent downplayed concerns, dismissing the downturn as market noise. He reassured CNBC that the fundamentals for a strong dollar and a secure bond market remain intact. But Morgan Stanley pointed out that April's data showed the slowest pace of business equipment investment since mid-2023. Bloomberg Economics even predicts that if tariffs persist, the economy could contract by as much as 0.6% in the second quarter. Trump's claim that foreign companies are flocking to the U.S. seems at odds with the data. According to the Bureau of Economic Analysis, foreign direct investment, FDI, dropped by 17% year over year. Is this a case of selective optimism, or are we overlooking deeper structural shifts in the global economy? On the consumer side, spending growth was sluggish in Q1, up just 1.8%, the weakest pace since mid-2023. Inflation, meanwhile, is proving to be sticky, with core PCE inflation at 3.3%, well above the Fed's target. The New York Fed's April survey also found that short-term inflation expectations among consumers rose to 6.5%, the highest in over 4 decades. Real wages have been declining for 3 straight quarters, putting pressure on household budgets. Ian Shepherdson from Pantheon Macroeconomics called this a stagflationary environment: slow demand, persistent inflation, and policy paralysis. With inventories building up in Q2, the next phase of this economic cycle could include job cuts, not price hikes. And the tariff war still shows no signs of being resolved. Trump continues to highlight the 22% surge in domestic investment as a sign of economic vitality. But as Bloomberg's analysis of BEA data shows, much of this increase was driven by businesses stockpiling goods in anticipation of higher tariffs, not investing in new capital or expansion. Additionally, the labor force participation rate ticked down to 62.3% in April, and housing starts fell 11% year over year amid rising interest rates and tighter credit. Core GDP, the term Trump's team has frequently used, is not an official measure of economic health. In fact, it's a campaign-created metric designed to divert attention from the 0.3% contraction in Q1. Fitch Ratings also noted that much of the 22% rise in investment hailed by Trump was due to inventory buildup, which has little to do with long-term growth or job creation. Meanwhile, consumer sentiment has hit a 10-year low, with 65% of Americans now expecting higher unemployment. While Trump's narrative suggests that a manufacturing revival is on the horizon, the hard data points to a more fragile economy. If the administration continues to focus on selective economic indicators, can voters and investors trust the numbers or the policies behind them? Looking ahead, the outlook is uncertain. As China steps up its currency trade and foreign investors retreat from U.S. markets, the dollar's global dominance is increasingly under threat. The U.S. economy may still rebound in Q2, but only if trade policies change course. And right now, there's no indication that this will happen. So, if the next quarter reveals deeper contraction, will Washington change its approach or double down once again? Drop your thoughts in the comments. What happens next could reshape the markets and the global business landscape as we know it. If you enjoyed this video, please like and subscribe. Check out another video we've prepared for you next.